Have you ever wondered how big companies like Facebook, Amazon, and Google get their momentum to grow and scale up? Well, it all starts with an investment bank. Investment banks play a crucial role in many of the biggest financial decisions that companies and individuals make. Investment banks have been around for centuries, shaping the course of history through their financial expertise. From funding the Industrial Revolution to facilitating the mergers of today's tech giants, investment banks have played a vital role in shaping our world. We all know money makes the world go round, and investment banks are at the center of it all. In this video, we will find out, what exactly do these banks do, and how do they make so much money? Investment banks are financial institutions that play a critical role in the global financial system. Unlike commercial banks, which focus on traditional banking services like taking deposits and making loans, investment banks provide a range of services related to capital markets, mergers and acquisitions, and corporate finance. One of the primary services offered by investment banks is underwriting. What is underwriting? Underwriting is like being a detective and investigating the company thoroughly. When a company wants to sell its shares to the public, it needs help from a special kind of bank called an investment bank. The investment bank's job is to help the company sell the shares to lots of people who want to buy them. But before the shares can be sold, the investment bank needs to make sure that they're a good investment. They need to check if the company is doing well and if people will want to buy the shares. This process is called underwriting. For example, let's say there's a company called ABC Corporation that wants to sell shares to the public for the first time. ABC Corporation hires an investment bank to help them with the process. The investment bank's job is to make sure the shares are a good investment for potential buyers and to help ABC Corporation sell as many shares as possible. To do this, the investment bank will first conduct due diligence on ABC Corporation, which means they'll review the company's financial statements, business operations, and other important information to determine the value of the shares. Based on their analysis, the investment bank will determine how much the shares are worth and what price they should be sold for. Once the investment bank has completed its analysis, it will then purchase the shares from ABC Corporation at an agreed-upon price. This is called underwriting. The investment bank takes on the risk of reselling the shares to the public at a profit, so they need to be confident that they can sell the shares for more than they bought them for. After purchasing the shares, the investment bank will then sell them to the public through an initial public offering, also known as an IPO. The IPO is the first time the shares are available to the public for purchase, and the investment bank will work to generate interest in the shares through marketing and advertising. In summary, underwriting is the process of an investment bank evaluating the value of a company's shares and then purchasing them from the company in order to sell them to the public at a profit. Another service offered by an investment bank is mergers and acquisitions. Sometimes companies want to merge with another company or acquire another company to grow their business. An investment bank can help them with this process, and they play a critical role in these mergers and acquisition transactions. They help companies identify potential targets, negotiate terms, and structure deals. Investment banks provide due diligence services to ensure that the deal is sound and that there are no hidden risks. Investment banks earn fees based on the size of the deal, and these fees can be significant, especially for large merger and acquisition transactions. For example, in 2016, Microsoft announced that it was acquiring LinkedIn for $26.2 billion. LinkedIn is a social networking platform for professionals, and the acquisition was seen as a way for Microsoft to expand its presence in the business and technology industries. To help with the acquisition process, Microsoft hired the investment bank, Morgan Stanley. Morgan Stanley helped Microsoft with due diligence, which is the process of reviewing LinkedIn's financial statements, business operations, and other important information to determine the value of the company. Morgan Stanley also helped Microsoft negotiate the terms of the deal, including the purchase price and other important details. The investment banks made sure that Microsoft got a good deal and that the acquisition was successful. By the way, guys, we hope you are enjoying this video, and before we go further, don't forget to like the video and don't forget to subscribe as well. The third service offered by investment banks is debt financing. Sometimes companies need to borrow money to fund their operations or invest in new projects. Investment banks can help them by arranging loans or issuing bonds. It's like when you need to borrow money from your parents to buy a new toy. The investment bank will help the company find the best loan or bond options and negotiate the terms of the deal. In 2019, Uber raised $1.2 billion in a bond offering. To do this, Uber worked with several investment banks, including Morgan Stanley, Barclays, and Goldman Sachs. The bond offering was a type of debt financing where Uber borrowed money from investors by issuing bonds that would be repaid with interest over time. Uber used the proceeds from the bond offering to invest in new technology, expand their operations, and pay down some of their debt. The investment banks helped Uber by structuring the bond offering, pricing the bonds, and finding investors who were interested in buying the bonds. The investment banks also provided advice on the terms of the bond offering and helped Uber negotiate with investors. The fourth service offered by investment banks is equity financing. Sometimes companies need to raise money by selling shares of their stock to investors. Investment banks can help them by issuing new shares of stock or helping them sell existing shares. It's like when you want to sell some of your stuff to your friends to raise money. The investment bank will help the company find investors who are interested in buying their stock and help them set the price and structure of the deal. In 2012, Facebook went public with an initial public offering. This means that Facebook offered shares of its stock to the public for the first time, and people could buy and sell shares of Facebook on the stock market. To help with the IPO, Facebook hired investment banks such as Morgan Stanley, JP Morgan Chase, and Goldman Sachs. These investment banks helped Facebook issue new shares of stock to the public and manage the process of selling them. In the case of Facebook's IPO, the investment banks earned fees for their services. The fees for underwriting the IPO were reported to be around $176 million, with Morgan Stanley receiving the largest share of the fees. Equity financing is a way for companies to raise money by selling shares of their stock to investors. In Facebook's case, they wanted to raise money to fund their operations and invest in new projects. By issuing new shares of stock, they were able to raise a significant amount of money from investors. The investment banks helped Facebook find interested investors, set the price of the shares, and manage the process of selling them to the public. In return, the investment banks earned fees for their services. Some of you might get confused. Isn't equity financing the same as underwriting? They are almost similar, with one difference. The main difference between equity financing and underwriting is that equity financing is the actual process of selling shares to investors, while underwriting is a service provided by investment banks to help companies sell their shares to the public. In an equity financing deal, the company is directly selling shares to investors, while in an underwriting deal, the investment bank is buying the shares from the company and then selling them to the public. The fifth service offered by investment banks is trading. Trading is when an investment bank buys and sells securities, such as stocks, bonds, and derivatives, on behalf of its clients to make a profit. Here's an example to help explain how trading works. Let's say that a client of an investment bank wants to buy shares of a company called XYZ. The investment bank agrees to buy the shares for the client, but before they do, they notice that the share price of XYZ is likely to go up in the near future. The investment bank decides to buy some shares for themselves too, expecting to sell them later at a higher price. After a few weeks, the share price of XYZ goes up, just as the investment bank expected. The investment bank then sells the shares they bought, including the ones they bought for their client, at a higher price, making a profit on the trade. This is how all these investment banks make money. They are an essential part of the global financial system, providing critical services to both companies and investors. Without investment banks, the global financial system would not function as efficiently or effectively as it does today. There is also a dark side of investment banking, which we will cover in one of our future videos. So make sure you subscribe to the channel